Welcome to this game-changing video that could very well be your first step towards achieving early retirement. We're going to be talking about how to retire early with sensible personal finance. You might think that early retirement is just for lottery winners or trust fund babies, but it's actually achievable for ordinary people like you and me, with the right strategy and mindset, of course. If it's your first time here, my name is Alan, and on this channel we talk about all things money, finance and investing. And that's what I also cover in my book, The Wealth Wisdom Blueprint, which is available on Amazon. I'll leave a link to that in the description below. So buckle up and join me on this journey to financial freedom. And if you enjoy this video, make sure to give it a thumbs up, subscribe to the channel and hit that notification bell so you don't miss any future content. As this topic can be quite complex, I'll split it over 2 videos so that you get a chance to digest the information and not get overwhelmed with me bombarding you with too much information. In this first part, we'll cover setting retirement goals, creating a financial plan, and saving and investing. In part 2, we'll talk about controlling expenses, increasing income, managing debt, monitoring progress and adapting, and transitioning to early retirement, before wrapping it all up and recapping what we've covered over the 2 videos. So let's get started with setting retirement goals. Let's start by setting some goals. After all, you can't reach your destination if you don't know where you're going. Now, to set retirement goals, we'll need to consider 3 main factors: your desired retirement age, your post-retirement expenses, and the size of the nest egg that you'll need to cover these expenses. First, think about when you want to retire. The earlier you retire, the more you'll need to save, so it's crucial to strike a balance between your retirement dreams and what's realistically achievable. You might have heard of the FIRE movement, financial independence, retire early, that we've mentioned in a previous video. The FIRE approach involves aggressively saving and investing to achieve financial independence as early as possible, often requiring significant sacrifices and an extremely frugal lifestyle. However, if the idea of cutting every corner and living on a shoestring budget doesn't appeal to you, don't worry. You can still pursue early retirement by making moderate, sensible adjustments to your lifestyle that strike a balance between maintaining a reasonable standard of living and maximising your savings. Think of it as a more sustainable, flexible version of the FIRE movement, tailored to your individual preferences and circumstances. The key here is to find your own sweet spot between enjoying life today and securing your financial future. By being mindful of your spending, making smart financial choices and staying focused on your goals, you can pave your own path to early retirement without feeling overly deprived or stressed. Next, estimate your post-retirement expenses. Consider factors like housing, utilities, groceries, healthcare, leisure activities, and any other recurring expenses that you anticipate during your retirement years. A common rule of thumb is that you'll need about 70 to 80% of your pre-retirement income, but this can vary depending on your personal circumstances and lifestyle choices. When estimating your retirement expenses, think about how your lifestyle might change after retiring. For example, you may plan to downsize your home, relocate to a more affordable area, or travel more frequently. Additionally, consider any potential changes in your healthcare needs and expenses as you age, as well as the impact of inflation on your cost of living. It's also essential to plan for one-time or irregular expenses, such as home repairs or replacement of major appliances. Building a buffer into your retirement budget for these unexpected costs can help you avoid financial stress during your retirement years. To get a more accurate picture of your post-retirement expenses, you can use online tools and calculators, or even consult with a financial planner who can help you tailor a budget to your unique situation. Remember, the more accurately you can estimate your retirement expenses, the better prepared you'll be to create a realistic financial plan that supports your early retirement goals. It's always better to err on the side of caution and overestimate your expenses, rather than underestimate them and face financial challenges later in life. Finally, calculate the retirement nest egg needed to cover your expenses. A popular method is the 4% rule, and that suggests that you can withdraw 4% of your retirement savings annually without running out of money. Let's look at some examples of various retirement income requirements. ranging from a modest lifestyle to an average lifestyle and up to £40,000 per year and above. For a modest lifestyle, if you plan to lead a modest lifestyle in retirement, you might estimate needing around £20,000 per year to cover your expenses. Using the 4% rule, this would require a nest egg of approximately £500,000. Average lifestyle. For a more comfortable retirement with a moderate standard of living, you might aim for an annual income of £30,000. In this case, using the 4% rule, you'd want a nest egg of around £750,000 to support your lifestyle. £40,000 per annum and above. If you desire a more luxurious retirement with an annual income of £40,000, you'd need a nest egg of about £1 million. For those aiming for an even higher income, say £60,000 per year, a nest egg of £1.5 million would be necessary. It's important to note that the 4% rule is a general guideline and may not perfectly apply to every individual's situation. Factors such as investment returns, inflation, and your retirement time horizon can impact the sustainability of your withdrawals. Some financial experts recommend a more conservative withdrawal rate, like 3%, to further ensure the longevity of your nest egg. Obviously, this means that your retirement pot would need to be larger in order to accommodate the smaller drawdown to give you the same equivalent income. Keep in mind that these examples are meant to illustrate the different levels of retirement income and the corresponding nest egg sizes. Your own retirement goals and lifestyle preferences will determine the amount that you need to save. It's essential to evaluate your personal situation and create a customised plan tailored to your unique needs and desires. As you work towards your early retirement goals, remember to revisit and adjust your calculations periodically. This will help you stay on track and make any necessary changes as your financial situation, goals, or market conditions evolve. By understanding the relationship between your desired retirement income and the size of your nest egg needed to support it, you'll be better equipped to create a realistic and achievable financial plan that allows you to retire early and enjoy the lifestyle that you desire. Remember, when setting retirement goals, it's essential to be realistic and flexible. Life happens and circumstances change. Keep your goals in mind, but don't be afraid to adapt them as needed. Next, creating a financial plan. Now that we've set our retirement goals, it's time to create a financial plan to help us get there. A financial plan is like a roadmap, guiding you towards your early retirement dreams. Assess your current financial situation. To create your plan, start by assessing your current financial situation. This includes your assets, savings, investments and property, liabilities, debts, loans, mortgages, and income, salary, side hustles and passive income. Now, you've got to be honest with yourself here. After all, you can't improve what you don't measure. You might want to check out the video that I made on budgeting basics to help you with this part. Identify areas for improvement. Once you've got a clear picture of your finances, identify areas for improvement. Maybe it's time to tackle that high-interest credit card debt, cut down on unnecessary expenses, or boost your savings rate. Whatever it is, make a note of it and incorporate it into your plan. Set clear steps and timelines. Your financial plan should outline clear steps and timelines to achieve your retirement goals. This might include setting monthly savings targets, automating your investments, or allocating a specific portion of your income towards debt repayment. Break it down into manageable milestones. Be sure to break your plan down into manageable milestones so you can track your progress and stay motivated. Celebrate your achievements along the way and don't be afraid to adjust your plan if needed. Review and adjust regularly. Remember to revisit your financial plan regularly to ensure that you're on track to meet your early retirement goals. Life circumstances and financial markets can change, so it's essential to remain flexible and adapt your plan as needed. Saving and investing. Now, let's talk about the backbone of early retirement, saving and investing. To retire early, you'll need to build a sizable nest egg, and that means putting your money to work through smart investments. You absolutely need to develop a habit of regular saving. Aim to save at least 20% of your income, but feel free to save more if you can. Obviously, the higher percentage you can save, the sooner you'll get to your goal of retiring early. Make 20% the absolute minimum you save and invest. Automate your savings to make it a seamless part of your financial routine. Remember, every little bit counts when you're working towards early retirement. Talking of every little bit counts, I personally use an app called Moneybox to round up all of my purchases and also save a set amount automatically each week. Moneybox has several different accounts to choose from a simple savings account to notice accounts where you have to provide a certain amount of notice in order to withdraw your funds from them. This type of account offers a higher interest rate than normal savings accounts. Another advantage of this type of account is that if you need to give notice, which can be anywhere from 1 month to several months, then you're more likely just to leave the money in the account to accumulate rather than choose to withdraw it. Moneybox also offers a pension account where you can find and combine lost pensions and make further contributions. As well as rounding up all your purchases from whichever nominated bank accounts you choose to connect to Moneybox, you can also choose to save an additional amount each week on top of that amount. The amount is collected by direct debit every week from your bank account and is barely noticeable. Personally, I've got 4 separate accounts with Moneybox. I've got a normal savings account, a 32-day notice account, a 120-day notice account, and a general investment account. The savings accounts are self-explanatory, and the investment account invests my deposits into several funds which I've selected. I don't have a pension account with Moneybox, but instead I've got a similar account with Pension B. I have nominated a small amount to be deposited into the Moneybox accounts each week, and I've got a reasonable amount of money saved which I would have otherwise not saved and probably spent on something that I didn't really need. Next, let's deep dive into investing. I've made a more in-depth video into the topic if you want to come back and have a look at that one, but for now, let's take a quick look at the various types of investments that you might wish to consider. Long-term growth investments like stocks, bonds, and real estate can help you achieve your early retirement goals more quickly. Here's a closer look at some popular investment options. Stocks. Owning shares of companies can offer significant growth potential. Focus on well-established, financially stable companies with a history of paying dividends for a more conservative approach. Bonds. Fixed income investments like government or corporate bonds can provide regular interest payments and a measure of stability to your portfolio. They're generally considered lower risk than stocks, but offer lower potential returns. Real estate. Investing in property, either directly or through real estate investment trusts, REITs, can offer both income through rent and potential capital appreciation. Low-cost index funds and ETFs. To get started, consider low-cost index funds or exchange-traded funds, ETFs, that provide broad market exposure with minimal fees. These funds track the performance of a specific market index, offering instant diversification and lower risk compared to individual stock investments. Taking calculated risks. Don't be afraid to take calculated risks, but always keep diversification and risk management in mind. Here are some tips for maintaining a well-balanced portfolio. Diversification. Spread your investments across different asset classes, that's stocks, bonds, real estate, and sectors, for example, technology, healthcare, financials. This can help protect your portfolio from market fluctuations and reduce overall risk. Risk tolerance. Understand your own risk tolerance and tailor your investments accordingly. Generally, younger investors can afford to take on more risk for potentially higher returns, while those closer to retirement, like me, should prioritise preserving their capital. Time horizon. Consider your investment time horizon. If you're investing for early retirement, you may have a longer time horizon than someone investing for short-term goals. Longer time horizons allow for greater risk-taking and more aggressive investment strategies. Rebalancing. Regularly review and rebalance your portfolio to maintain your desired asset allocation. This helps ensure that your investments remain aligned with your risk tolerance and investment objectives. Minimizing fees and taxes. Here's a pro tip. Minimize fees and taxes wherever possible. For instance, Take advantage of tax-efficient investment accounts like ISAs or SIPs to boost your returns. Also, look for low-cost investment options such as index funds, which can help you keep more of your hard-earned money working for you. Consistency and patience. Remember, the key to successful investing is patience and consistency. Stay the course, regularly review and adjust your portfolio as needed, and let the magic of compounding growth work in your favour. Learning and staying informed. As you embark on your investing journey, make a point to educate yourself about different investment strategies and options. Stay informed about market trends and changes, and don't hesitate to seek professional advice if you're unsure about your investment decisions. By focusing on saving and investing, you'll be well on your way to building the nest egg necessary for early retirement. Keep in mind that the journey to financial independence requires dedication, discipline, and a willingness to learn. With time and perseverance, you'll see your efforts pay off as you move closer to your retirement dreams. Okay, so that will do us for today. We've covered a lot of ground here, so I'll give you a chance for it all to soak in. Once you've digested it, be sure to tune in for part 2, where we'll be covering controlling expenses, increasing income, managing debt, monitoring progress and adapting, and then transitioning to early retirement. If you're looking to take control of your finances, understand the basics and grow your wealth, then this is a channel for you. Make sure to like the video and subscribe to my channel to keep up to date with all my latest videos. And let me know down in the comments which topics you want me to cover in future videos. Thanks for watching. Remember to check out my book, The Wealth Wisdom Blueprint, and I'll see you in the next video.